So the accounting works on a double entry system, like human. We work on two legs, right? If we have only one leg, we buy another one, but we have to have a balance. So the accounting also works in the same way. It has to have a balance. Two transactions, two leg of transactions. Okay. So two double entry system. So every every transaction has two sides. Even in a real life transaction, if you are giving something, you are getting something back, correct? Which is measured in value, which is measured in terms of money. When you are selling something, what are you getting back? And what are you giving? Your product or your services, correct? Which is measured at the same value, correct? In olden days, when we were doing the transactions, when there was no money, we used to barter, correct? You take my laptop, I take your laptop, or you take my rice, I take your meat, correct? And the value was like this, same, we work in the same way, right? We sell something and we get something back. So accounting works in two ways. One is something we going out, something is coming in. Either we receiving something physically or right, or we can call it our gain, right? Whatever we are making, or in return of giving something back. So it can again be physical or it can be only a right. So we have two transactions. One is we are giving and one is we are getting back. So we need to record both sides of transaction at the same time. Otherwise your accounting will stumble, okay, if you have only one leg. For example, sales, either we can sell in cash or we can sell in credit. Okay, how we are going to record, we will look at the next slide, but at the time you just understand there are two types of transactions. What we give is our goods and what we get is cash or right to receive a cash in the future. Hiring a staff, what we get? Services from their staff, which is valued equal to the salary that we are paying, correct? In real life, the staff is giving much more value to the business, more than what you are paying to the staff, right? But you cannot record that extra. You can record only up to the level, up to the salary that you are paying. Okay. So to record the transaction, we use something called T account. So the T account means it's like a T one account. So where we record one side debit, one side is credit. So you can use debit side, credit here, debit there, or debit here, credit there. It doesn't matter. What matters is that both sides need to be same, because we are using two sides of transaction, right? So how we use it? Every financial transaction has two sides. Debit means something receiving, mostly means coming in. Whatever comes in or whatever we get, normally we record as debit, or we expense, we lose. Whatever we give back to anybody, we normally record as credit. Okay, in accounting term, credit means your liability or your gain, and debit means your assets, whatever is your right to receive in the future. Okay, so there are some fundamental rules which you need to know when you are recording the transactions. So the rule one is whatever coming in need to be on the debit side, and whatever is going out need to be on credit side. So in the previous example, we look at sales in cash. So what went out from our organization in sales? Your goods, correct? So what will be the accounting? If let's say we want to record accounting transaction, what will you record? How will you record it? What will be the credit? Sales, right? Your sales or your goods, that particular good will be credit. And what will be the debit? What is coming in? Cash is coming in, right? So the accounting entry, so we call this one financial transaction, one accounting transaction. These two sides will form of one transaction, right? So debit, cash, credit, either sale, or you can call it that goods name, whatever you are selling, or services, you can say consulting, you can say anything that you are selling. Okay, So that means this is one transaction. The second rule in accounting is debit the receiver. Means whoever is receiving the money from your side, it should be debit. And credit the giver. Whoever gives the money to us will be credited. So if let's say you sell something on credit, now the person is paying you the money, correct? So in this case, what is happening? Who is giving the money? The customer, correct? So you will receive, you will debit, you will credit the customer, and what you are getting back? You are getting in money. So you are using rule 1 and rule 2 together. So it's not necessary that one transaction will follow only one rule. The one transaction can be affected by two different rules. So here, if you receive money from your customers, you are basically receiving the money from credit the giver. Means whoever is giving the money will be credited. But what will be the debit then? That is not written in this rule, right? That is written in this rule. Debit what comes in. Okay. So whatever is coming in means cash is coming in. So the accounting transaction will become debit cash, credit the person who gives the money. Okay. Rule 3 is debit all your expenses. Whatever is your expense, whatever you spent is your debit side, and whatever is your income, you may be selling something, right? So that is your credit side. Okay. The last rule number 4 is debit all your assets. Whatever is you hold. If let's say you buy a laptop, you buy a house, you buy a car, it always will be debited because you are getting in something, right? And in return you are paying something. You are paying money. So that will be credited. So these all the accounting transactions, the whole accounting transaction will follow only these 4 rules. These are like foundation. Okay, so you can either take a picture or you can note it down so that you remember. At the end of this, we will do a little exercise to understand these rules better.
I have a question. I don't really understand rule number 3.
Debit expense and credit income.
Yeah, because you said debit is what comes in, and expense is what you give. So why is debit the expense?
Okay, debit expense means that's why it's a rule, because there's rules are rules. So debit expense means expense is what? What is your expense?
Salary.
Yeah, salary, right? So you are giving salary. So but you are not giving salary, you are giving cash. Correct? So it will follow rule number 1. Cash going out. But what is coming in? Nothing. Your only services are coming in. But you cannot record services, right? Those services are your expense. You are hiring a consultant to do a job for you. So that is an expense for you, right? So that expense will be debited. So debit the expense and credit the whatever is going out. So if you are paying in cash, you are paying in credit, that will be going out. So expenses will always be debited. Means you are using the money for your business. So it can be rent, it can be salaries, it can be printing and stationery. So you can say a contradicting rule. Let's say you are buying a stationery from outside, right? So what is coming in? Stationery. So that will follow the rules, right? Debit what comes in. Or it can follow the rule debit expenses. So stationery, when you buy a pen or pencil from the market, it's an expense for you. But you can follow rule number 1. What is coming in? Pen is coming in. So you debit pen, credit money out. But pen is what you are going to do with the pen. You're going to use in your business, right? And that you can record either as an asset or as an expense. So what you will record as an expense and what you will record as an asset depends on the business, depends on the size of business.